I'm so bad at saving, too broke for rental. This cost of living is driving me mental. Wanna move out, get away from parentals. Don't forget to invest, I'm feeling stressed. Cause what if I can't retire? I'll probably just expire. Can someone give me an answer? And keep it simple. Keep it simple. Keep it simple. In this episode, we invite Shirley back to share her experience with investing that didn't go too well, in addition to 4 actionable steps for beginners to take when starting out investing. Also, Pris has a huge problem with Fomo. Stay tuned for all the tea right till the very end. So Pris, how has your investing journey been? I remember you telling me you've started recently.
But yeah, like quite stressful
Why is it stressful?
because I feel like I'm constantly missing out. Or at least like, my head tells me I should just passive invest or like I shouldn't give in to the hype of Tesla, of like investing in Facebook, all this kind of thing. But then, my heart is like, but I need it.
You need Tesla, Facebook, and Apple.
Yes, I need it. I need to buy me 2 apples.
Okay. But why do
investing
you
in ETFs.
But why do you feel that way? Yeah, so you're buying ETFs right now?
Yeah, I'm buying ETF. I'm buying like a mix of actively invested ETFs and the Straits Times Index.
Exchange traded funds, right? ETFs.
Yes, correct.
Yeah. I'm also buying the Straits Times Index.
Yeah.
But I don't feel that FOMO feeling you're talking about lah.
Really? I feel
I'm
it
fine
all the
without
time.
I'm fine without Tesla.
I feel it all the time because my boyfriend keeps telling me, hey, like Tesla like jumped to this much. If you invested last month, you could have earned like $3,000. This kind of thing.
Wow, so stressful. I think I will be constantly unhappy. Yeah, right.
I'll be like, oh no, did I just lose $3,000?
No, but you can't think that way, right?
Yeah, I know.
Yeah.
But it's so hard when like the people closest to you, I'm talking to you, my boyfriend. Like tell me about this. I mean, it comes from a good place of like, hey, I wanna tell you about this news, like, so that you can make money. But it's quite hard for me to choose between being like passive and more aggressive.
Yeah.
Especially when now I'm trying to concentrate more on saving.
Yes.
Yeah, so I have limited funds to spend on investing.
You need to get your priorities in order.
Yeah.
Right? And I think if you keep hearing all these news from like your boyfriend and whoever else,
yeah,
it can get like you can get sucked into it. Then it becomes a bit too, because you're leaning into your emotions of like, oh no, I'm missing out on like Tesla's, I don't know, $3,000 whatever.
Yeah, it's like saying like, oh, this LV bag is on sale right now. It might go up in price anytime. You could buy it right now and then you could sell it for 3 times the price.
Yeah. So
what do you say?
I say we should not just jump the gun. Yeah. So I think so I guess that's why we have invited Shirley back onto the show. Hi Shirley, you've been listening to our dialogue for the last 2 minutes.
Thank you. Thank you for indulging my story.
I was trying not to jump in, but yes.
Yeah, we have to let Pris speak her mind first. That's how it usually goes.
Yes. Thank you.
Yeah, I don't know about whether the LV bag will appreciate 3 times the value.
I mean, a girl can dream. A girl can dream.
If you've got this kind of thing, you must let me know. I also want to. Yeah. So this is a follow-up episode from the last time all 3 of us were together talking about finances for women. This episode we want to talk about investing, since we've already established that me and Pris have recently started investing. We are baby investors.
Baby investors. We are baby.
Yeah, we only started. So we're only like a few months in, into our own investing journeys. So I thought that maybe we could ask you, Shirley, for some advice, or if you have any like stories. I know we hinted at a story in our very first episode.
Top secret juicy story.
Yes, exactly. That was exactly what we said. Yes. Yeah.
Well, I won't say that I have like very distinct advice, but I'm gonna throw a whole bunch of suggestions out there later. But as promised, the last round, I said that I have a crazy story to share about my investment journey using my CPF, which was a big learning lesson for me, right? And I should go into the specifics even.
Yeah.
So I started to look into utilizing my CPF for investments during a period of time in 2007 period, 2008, right? Commodities went up like really, really high. Yeah. And then like when there was a crash in 2008 and 9 period, I started to look into like wanting to invest into commodities.
Right.
Yeah.
For our audience, what are commodities?
So commodities can take in the form of like how you invest in them can take in the form of like through a fund, through ETFs as well. And I chose to invest using a fund because a fund is managed professionally by fund managers. You pay a much higher management fee, sometimes like 4 to 5%, and they choose to invest in this case like metals, gold, hard and soft commodities. It can go into like mining sector, oil and gas as well, iron and steel. And then there's always geographical allocation. So some of the top countries would be like Canada, Australia, US companies, and UK companies. Yeah, so the professional fund managers will choose the countries where they want to invest into in the stocks. And also like which area, which company exactly, and in what kind of commodities.
Okay.
So the price came down, and I still remember the name of the fund. It's called First State Global Resources. It no longer exists now. So it went to a very high price, close to, then it's like around $2, and then it crashed down, right? So when it came down, I thought Fomo, must go and buy it because commodities was hot. And I even have a systematic approach to do it. So I say like, okay, I'm going to put 100,000 CPF money and divide it into 2 lots. Yeah, which is like 50,000 that went in at $1.62. I went to draw out the past information, and the other 50,000 at $1.69. So it's like averaging it, right? Thinking about that. But I left it there, not really watching it, and not really like trading it. And it just came down in between that, never seen like the daylight of where its high was.
Right.
Yeah.
So from that point on when you bought, then it just kept going down.
From the point that I bought, which is a range, right? So I bought them like a couple of months apart, 50,000 each.
Yeah.
And it never went back to the high that it used to be.
Right.
Yeah. So because you thought that, oh, I've seen that high before, it came down, then quickly go and buy, right?
Yeah.
Yeah. But it never ever went back to that kind of high.
Oh no.
So 7.5 years later, which was like in September 2018, I decided like, okay, enough is enough, right? And
10 years later.
7.5 lah. 7.5 years later.
Yeah.
2011 to 2018.
Oh, 2011. Okay.
Yeah. So by the time I sold the unit trust, then out of the 100,000, I got back like $52,488.
That's a big loss.
So it's like a loss of like 47.5%. Yeah. So what was like the biggest lesson for me was not so much about like choosing a better investment. I actually didn't even know why I went to that investment. What did I want to plan for that CPF money, and why did I go into the investment? So there was a correction, and then like Fomo sets in, and then straight away I jump into it because commodities was also a hot sector.
Yes.
And I thought if I invest using my CPF money, it should like generate like much higher return than leaving it in CPF account itself, right? So I went into something like more risky. Yeah, and riskier asset class, and I didn't monitor it, which was another like terrible thing in between. Yeah, so then the outcome at the end of the day, after like many years, was a very terrible outcome. Yeah, it was very good lesson learned for me, and I actually reflected what I should have done when I look into investment. Yeah. So coming back to you wanting to chase after Tesla.
Yeah, I was thinking, while I was listening to Shirley talk, I was like,
Facebook and
like,
all that.
yeah.
But you know what everyone will say? Tesla is different.
yeah, but that's what you say about every other hot
Tesla is
potato that comes by, right? Yeah, but there's potential.
Which is why I haven't put any money into Tesla or any of these companies yet.
Yeah, but then
the temptation is still there, lah. Definitely.
yeah, and I get the sense that your reason for choosing Tesla is because, I don't know, like because it's like hot now. Is it?
Actually,
or is it? Do you like Elon Musk as a person?
No lah. It's because like because they are working on like space travel.
So you feel like it's the future?
I think space travel is the future. Like
very far into the future.
I mean, I might still be alive.
Okay.
when it happens, because I don't know, because like technology kind of stacks on itself, right?
Right.
So the further we get into the future, the faster it will accelerate.
Okay.
So
that's your So
that's my reasoning. But then
valid, I guess.
But I think there's a lot of people's reasoning as well.
Yeah.
Like Tesla is like so future looking, like forward looking. So then everyone wants to invest in the future, right? So that's why I think that Tesla is like this hot thing now.
Disclaimer, this is all just our personal opinions. Please
Yeah. This is really
advice.
my like very personal opinion. Not based on facts, data or anything. Yeah.
You kind of reminded me of like why I made that decision
to
invest into the commodities.
Flashback
no.
Because it's a lot like, I feel that this sector is gonna, go up. I feel that this is gonna go to where it was before. And it is not like I have actually taken like systematic steps to understand more deeply about that particular company and for example, what kind of dividends will it be paying, what kind of earnings for this particular stock is it making. You're investing kind of like in a dream,
exactly.
which will come true or not, and time will always tell, right? And you are also investing or planning to invest into something that is hot and everybody is trying to get in. Correct. So there's a lot of red flags there. Not because
I haven't put anything. Guys.
Not because the stock is a red flag. It's just more the emotional thinking behind that are all red flags. And which is why I've learned not to place myself in that same position ever again.
Listen closely, Pris. This is all for you.
This podcast is yet another podcast to address one of my problems.
This is problem number 2 already. We need to start counting. Yes, okay.
Up to 99 problems.
Oh my god, okay.
So I formulated 4 simple steps that young investors can take based on some of the learning lessons that I have for myself as well.
Okay.
So I'll put them in 4 distinct points. The first point is when you start investing, I think one of the first things that you need to do is to spend a few months really understanding like the different asset classes, right? And which ones you would like to focus on. So for example, different asset classes would include like, is it equities, is it commodities, currencies, or bonds that gives you regular return and all that, right? So the different asset classes will let you have an overview like which one would be most suitable for you at this point in your life. And then you dive in to deeply understand which ones you have best interest in, which one attracts you most, and that you want to take one step more into that. So that's one. Second, I think based on like your goals and what you hope to achieve, and the interest consideration when you're reading in broad stroke, right? Which one you have most interest in, and focus your learning in those selected asset class. So if it's equity, focus on like understanding the equities or the ETFs and gain like deeper knowledge into that, right? And before you make a decision. So for example, ETFs, like the broad top-down or global approach. If you buy an ETF that is like STI ETF, Singapore Stock Exchange, versus the US ones, which is also equity, like S&P 500, versus Hong Kong Stock Exchange linked kind of ETF, the result looks very different because the while it's in equities, like the US equities has shot up quite crazily, whereas the Singapore ones are actually going on to like a diving mode, right? So even when it's equities, you also have to see like what kind of global dynamics it is. And yeah, you start to gain your knowledge on that. Yeah. And then the third one is, of course, quite important to choose the right platforms and channels. Yeah. So that will include like what kind of brokerage houses will you go for? Do you go for like fund managers, which you have to pay quite a huge fee for? Is it robo advisors? Do you just go into a platform to just buy your ETFs because it's low maintenance, quite passive, and the fees are also quite low? Yeah, so choose the right platform according to what is suitable for you. And then the last thing, which is the thing that I didn't do, is to take action and review regularly. Yeah, because that review is important, that continuous learning in that area is quite important, and to practice. Yeah, so if you take actions to invest, then you will see results. And if you see results and you monitor regularly, then you'll gain more confidence. And when you gain more confidence, then you'll be more willing to expand that knowledge and continuously invest with confidence. Yeah, so yeah, I would say like these 4 points are quite important learning lessons for me. If I go back to my 21, 22-year-old self, this will be the steps that I would take.
Yeah. I think they make sense also, because you have to understand, like the first one is learning more about asset classes, which is very important, because if you don't know, then you're kind of going in blind. This reminds me of when, actually in poly, right, I took this elective module because I wanted to like, I don't know, just clear my credits or whatever. And then one of the modules was basics in investing, and I was like 17 years old, okay, I don't know what I'm doing. Then I went to class. Then the person, the lecturer or the whoever teaching was like, yeah, okay, so he didn't give us that good of an overview. He was just like, yeah, investing is just you put money in, and then I don't know what he said. He said, then you will like make money from these stocks and shares. Then he said, okay, so we'll practice. And then he gave us like...
We'll practice.
Yeah, so he gave us an actual practice account. Like, so it was like a simulation of the actual stock market.
Right.
So it looked exactly like it, and I was like,
you mean Neopets?
Yes.
Stock exchange on Neopets?
Yeah, so it was like an imitation. I think it was tracking the stock market for real or something, and then they gave us fake money. So we had like, I think they gave us maybe 500k or something.
Wow.
500
fake money.
Yes, it was
Love
all
it.
fake money. Okay, and then I remember just fiddling around with it because I didn't understand what I was doing, and then I lost all my money in like 10 minutes.
Wow.
I was like, okay lah, never mind.
Never mind.
Imagine if it's like real money, whether you make the exact same decision.
Yeah, exactly. And then that's when I realized I don't know anything about investing, and then this guy is also not helping. Then like, yeah, so I mean, it's very important to get your fundamentals right, because even if it's fake money, the fact that I lost it all in 10 minutes.
Scary, yeah.
Yeah.
But I think invest with a accomplished purpose or goal is quite important. So for example, if I have thought about what was the goal or the purpose for that 100,000 in my CPF account, I wouldn't have invested the way that I've invested. Yeah, if I set quite clearly that goal is to grow a certain like 7 to 8%, for example, or is it for long term but stable kind of return,
Right.
then that purpose will be quite different from like an aggressive and risky kind of asset class. Yeah, so that goal is important because we all have like some of our, I mean, all our goals would be different in terms of priorities.
Yeah.
But generally most of our goals are pretty much the same, right? So you save and you invest for like marriage or purchase of a house or car, or for travel and big spendings, for our dreams, or we're planning for retirement in the long run, or is it to build a family or build some rainy day fund. Yeah, so once we have that goal set quite clearly, then we can make decision for different pots of our money and savings, and how we're going to invest in it with a clearer mind, I would say.
That makes sense. A lot of those goals that were just listed, I think, Pris, you are saving for those, right?
Yeah.
She looks like she's in deep thoughts.
Sorry,
thinking about her life.
I'm quite overwhelmed. I don't know. I always felt like, you know, to save or like to build money for things that I need, such as like a house, like for like maybe if I want a baby, maybe my needs will also change. Maybe I don't need a baby. Maybe I need to. My need now is I want to do a career switch. You know, like I think I always felt like I needed to save money instead of invest it because like I think for things that you need, it's more secure to save money instead of investing. So that was like my thought process. So now I feel like, you know, those long-term needs or long-term goals that are necessary in my life, like I think it's good to take this kind of approach. For me, I would put it into a lower risk for things that I will definitely need. And then like for things that I want, like for example, let's say if I want a car next time, I don't know, that's a want for me. So these are, I'll put in money that I can stand to lose and not totally like lose the things that I need. Yeah.
I think maybe it's because like our perception of savings is that it's very, very safe.
Yeah.
Right.
Secure.
And then our perception of investments is that there'll be risks that we need to take, right? So the risk could mean that the returns come back to be completely, well, most of the time it won't be completely zero, but it could be like less than what we expect it to be. Yeah, as a principal sum, so that might affect us psychologically.
I was just thinking that even if you have savings or like you save for a long-term goal that you need, it's not totally safe as well because of inflation. So that's another danger that I realized much later. Like I only realized recently. So actually maybe if you put it in an ETF or like a low risk investment, it might even be safer than just saving. Yeah. So I guess what I need help with, obviously it's all about me. But like maybe what I need help with is all these steps are really good, but like how do I apply it to my investing journey?
Yeah, first the visual of the simple sum character comes into my mind.
Oh, which one?
Which character?
No points for guessing it right.
Is it Sam? Is it Sam? Is it Sam? Yes, I don't mind being Sam.
You are now our Sam.
I believe it's good to create for a start, right? Like 2 separate fund. One which is a steady fund, and the other one is an opportunistic fund. So a steady fund, and exactly like what you mentioned, if you save and you don't really invest at all, and you put in like the savings account, it's going to give you like less than 1% interest per year.
Yeah.
So that's not even enough to beat inflation, which means that what you can buy with that $1,000 now, you can buy much, much lesser, the equivalent of anything that you want to purchase down the road. So that's the concept of inflation, right?
Yeah, your purchasing power.
It
declines.
gets lesser. So you probably need to spend more buying the same T-shirt that you always love, or the guitar that you always love, for
Direct
much
attack.
more. Yeah. So like for example, a steady fund. If you start to invest at the age of 25, and you start with a pool of 10,000, and every month you save consistently and invest consistently like $300 at 5%. 20 years later, right, at the age of 45, if it's consistently this way, you actually have like 145,000. Yeah, and that's to take into consideration. Let's say if you have a basic salary or take home cash of $300 monthly is just like 10% of what you need to save. So it is very doable. Yeah, and if systematically at every interval, like every 5 years interval, you set aside a new pool all the time and hoping to achieve 5%, and with $300 monthly, you project 20 years later how that would look like. And for like between the age of 25 all the way to 40, you consistently put that kind of money aside, and you should be able to achieve a very good outcome that is 7-digit when you are at the age of 60, for example.
Right.
Yeah. So that's the power of compounded return. That's the power of investing as well, especially in such low interest rate environment. Yeah, so you don't have to always, I guess, go into like the fear of the opportunistic kind of investment. Yeah, and you should always think about having pockets of money for those steady fund and opportunistic ones, like for example Tesla, that you're so crazy about, right?
That's
Elon
right.
Musk, if you hear this, Pris loves you.
I love you.
Yeah.
Yeah, I think this step by step is super helpful, but at the same time, yeah, it definitely requires a lot of discipline,
Yes.
because
Yeah.
you need to have this large amount of money every 5 years, I suppose. I mean, it's quite doable, considering that every month you only put in like 10% of your salary projected, assumed. Yeah, so
I can share this formula and the matrix as a guideline,
yeah.
like what I would recommend, let's say my niece or nephew to do, kind of a
Yeah.
scenario, right?
Yeah.
Yeah, and and if it's useful, then y'all can follow and tweak the formula a little bit with you and your listeners.
Yeah. We could, I mean, I could see this going into an Excel sheet. Then you can just tweak like the amount lah.
Yeah,
the
that
amount.
you input. Then you can
Yeah.
just kind of
Yeah.
simulate it.
Because not everyone needs the same amount of money for retirement.
Yeah.
Yeah.
And I guess young adults who's starting for the first time, what they would need is usually like just guidance initially.
Yeah,
Yes.
like
Yeah.
a baseline. Just
Correct.
a baseline.
And then with the
Yeah.
guidance, then everyone's circumstance is different.
Yeah.
And then you will tweak accordingly to what's most suitable for you.
Right.
Yeah.
Right.
But I still think that it is extremely important to start to learn about finance in general, the different asset classes as a base start.
Yeah.
Because it's a lifelong skill that the earlier you start, the more experience you accumulate, and the more asset classes you can learn. And of course, yeah, we discuss about why are we investing, what kind of goals are we trying to achieve. It's also quite important to have that clarity in your mind, and that will help us to stay focused and choose the right platform and continue to start taking the action and then continuously review it.
Hmm.
Yeah.
So I test you, what are the 4 steps?
So, step 1, spend a few months to learn about the different asset classes.
Yes.
Yes.
And then step
And what's
2.
step 2, Pris?
Step 2. I'm prepared for this.
Curveball.
Step 2. Decide what are your goals.
Oh,
Yeah. And then
okay.
align the type of asset class that you want to invest in according to your goals.
Right. And goals can be like needs or wants, right? They're
Yeah.
not one and the same.
Yeah, correct. You think you can divert it by asking me a question?
Yeah.
So what's the third one?
Step 3, figure out which channel or platform you want to use. Right? Correct? Am I right?
Correct. What kind
Yeah.
of channels?
Bro-
Would we-
brokerages,
you
you
know?
know, brokerage platforms.
Oh, like Robo also, right?
Yes, you could also think about going the robo-advisor route.
Fund managers,
Yes.
although that one comes with a really high fee.
Yeah.
So, but it's up to you. What are your goals? Remember, step 2.
yeah.
And then the last step is
Yes.
to take action, because we won't really understand how it all works unless we try.
Which is true because, investing used to be like just a concept to me until I started. No, for real.
Yeah,
until I started
same.
doing it, right? I bought like shares, ETFs, and like some other shares, and then I realized, oh, I don't know, something just switched for me when I started doing it. Then it suddenly became more real.
That's because you have something to lose.
Is it? Is that the feeling?
You have like
Oh.
skin in the game, you know.
Oh, that is the feeling.
Yeah, you're like part of it now. You're part of the country's like economic system.
I guess when you put money into it, you're like, okay, now I really have to tune in and
Yeah,
pay
yeah.
attention. If not,
Last time it's like I can ignore. It doesn't
yeah,
matter.
last time, yes, I've read all these articles about investing. Yeah.
Very good. You have all the 4 steps
Yeah.
described in your own words there. And
Special words.
Yeah, that's right. Yeah.
It should be quite easy to follow.
Yeah, and I like that you also brought up like the steady fund and an opportunistic fund, because I think, right, well, I don't know about others, but the things that I hear from my friends, they seem to all have the impression, sorry to all my friends who listen to this, but it's true. They seem to have the impression that investing is overall just a very risky thing. Like, it's just like gambling. That is their impression. But then, you know, now we know that there's you can be like more steady with how you invest it and more risky, more opportunistic.
I think it's all about balance lah, right?
Yeah.
Yeah. I mean, to balance out my possibly future Tesla investment, I could have like 10 times more STI investments. I mean STI, like, you know, your name sounds really suspicious on without context, but Straits Times Index.
Yes.
Yeah. Okay.
So just because we are here together and I have my computer in front of me, this is a good way to take a look at, even if you're buying something that's quite passive like an ETF, it's good to start to learn about global trends, and global stock market if you're going to buy like the equities kind of ETF.
Right.
Yeah. So you can see the vast difference when you have invested into a Singapore STI ETF that's gone down, you have not seen its high ever.
Yeah
Here. So you can see this. So it's still trending at a very low level, versus with the same amount of money, let's say you have placed into a US S&P 500 kind of ETFs. It has actually gone up quite a lot, even though it has gotten a bit of a correction recently.
Right.
So with the same amount of $1,000, what it can do for you is opportunity cost to you. And you can also take a look at the Hong Kong one, right, which has also when it came down in April, it's gone up to a significantly reasonably high level.
Right.
So if you have $1,000, then where would you put your $1,000, right? Of course, now looking back, you can see the trends, but that's where the $1,000 makes a difference in where you're going to place it if you understand and start to learn about global trends. One of the easiest way maybe for young people is to first start to mirror like a good professional out there, like in terms of what they choose. So as you mirror someone with good track record out there, you start to learn while mirroring instead of figuring out everything on your own. So you can mirror whether they are following like what kind of global trends, what kind of stocks, for example, and then you choose one or two to follow and start to learn from there as a base foundation. I try not to recommend like books or like people. I can recommend, like, for example, where to start learning. You can start to read on a regular basis, like spend just 10-15 minutes reading Bloomberg or Market Watch, right? Or like your Yahoo Finance kind of site that's quite general and generic to get you a good broad picture. Then you start to narrow down. Always invest in things that you can understand and you know. If it's too complicated and you cannot understand, then don't touch it.
Okay.
Okay,
that's
that
a
makes
good
sense.
rule of thumb.
So that's it.
Okay.
I think.
So Pris, how do you feel? Does that solve your problem?
I mean, I don't think that just talking will solve the problem. I think
Has it shifted how you feel about Tesla?
I think not. I mean, not really, because I don't think that. Okay, I think now when I look back, I don't really think that I had a very strong feeling about Tesla. I think I just had a very strong feeling of the FOMO.
Yes.
So I think the problem that I need to fix is how to deal with the FOMO and how I can better shift my focus to more what should my goals be instead of like, oh, Tesla, money.
I think one good way is to basically what we've just discussed go to your fundamentals. I think the more you know, the less likely you'll be swayed by other people's like
definitely.
sudden news like, hey, I got insider tip Tesla.
I also feel that way, because when Shirley was telling us about was throwing all these terms like equity,
Commodities.
Commodities, active funds. I was also like, oh no, I do not know any of this.
Yes, it's time to
So I think I need to
go and do some
educate
reading.
myself.
Yeah.
Before I do anything else. Yeah.
Which is what our audience members should also do if you guys are thinking of starting to invest this year.
Yeah, don't feel like you're missing out on anything. Like, I know this year everyone is like going into investing. I mean, me included, Soap included as well.
Yeah.
Like, cause everyone's like, the market is down. So if you don't go into it now, you're like missing out.
Yeah. It doesn't mean that you won't have another good chance.
Yeah,
because
exactly.
that's not a good way to think about it.
Yeah, better to educate yourself first before jumping into anything too rashly. Yeah.
Yeah. Okay. So
The market is always there.
yes.
Yeah.
Listen to Shirley. The market is always there.
That's right.
Yeah. Okay. Well, thanks Shirley for once again educating us
Yeah.
and sharing.
Just sharing
Yeah.
experiences.
Thanks for sharing. We really did learn a lot, especially the 4 crucial steps.
Yeah, I think it'll help to put thoughts into actions very clearly, or much more clearly.
So we will summarize our 4 points in our episode show notes, including perhaps maybe we will create an Excel sheet for everyone to try and simulate the plan, the part about the steady fund and the opportunistic fund.
Yep, correct.
So we'll include all of that in our show notes. So if you guys think you're gonna forget or you didn't take notes during this episode, never mind, because I took notes for you.
Yeah.
So so you can find all of that in our show notes.
Yep. And for all of you who feel like $3,000, that's not for me. I'm 25 and I'm earning $6,000. So then, in the Excel sheet that, we might possibly or maybe put out, you can even adjust for your own future, for your own like retirement, you can adjust the figures to tailor to your own needs because all of our goals are different.
That's a wrap on another episode of Keep It Simple. Leave us a review on any of our platforms and remember to subscribe to us for more episodes.
We publish every Friday because it's the best day of the week. So stay tuned and see you next time. Until then, keep it simple.